Most Americans believe the decline of the US dollar is a recent problem. They blame modern presidents, stimulus packages, wars, and reckless money printing. It is comforting to think this is new, accidental, and reversible. But the truth is far more unsettling. The dollar did not suddenly lose its discipline in our lifetime. It did not start weakening after World War II. Its transformation began more than a century ago on a quiet winter night when America was distracted, Congress was nearly empty, and history quietly shifted course. The most important financial vote in American history did not happen during panic, war, or economic collapse. It happened just before Christmas, on December 23, 1913. No riots followed. No dramatic headlines screamed danger. No urgent speeches filled newspapers. Just a procedural vote that permanently altered how money works. Welcome to Finance Historian Time. If you want to understand how hidden historical decisions made more than a century ago still control your savings, your assets, and your future, click subscribe. Because this story is just about the past, it's about the system you are living inside today. To understand why that night mattered, we must first return to an America that had a very different relationship with money. For most of the 19th century, the United States lived under a harsh, chaotic, yet brutally honest financial reality. Money was constrained. Gold imposed limits. Banks could fail, and they did, often spectacularly. Speculators who overreached were punished swiftly. There was no government backstop, no safety net large enough to save everyone. This system created pain, yes, but it also created discipline. Prices remained relatively stable over decades. A dollar earned by a worker retained value across generations. Inflation was not an invisible tax quietly eroding purchasing power year after year. The system did not protect everyone equally, but it did not lie. It rewarded caution and punished excess. Ordinary Americans endured uncertainty. Financial elites feared it. Bankers and industrialists were not afraid of inflation. Inflation could be predicted, managed, and even exploited. What they feared was chaos, sudden collapses, panics they could not control. Fortunes wiped out not through poor decisions alone, but because of timing, circumstance, and the whims of the market. That fear became urgent in 1907. In that year, a speculative attempt to corner the copper market failed. What should have been a contained disaster spread rapidly. Trust between banks evaporated. Depositors rushed to withdraw cash. Credit froze. The entire financial system teetered on the edge of collapse. There was no Federal Reserve, no official lender of last resort. No institution designed to stabilize markets. So the system turned to one man, J.P. Morgan. Morgan summoned the most powerful bankers in the country to his private library. Doors were locked. Balance sheets were examined by candlelight. Morgan personally decided which institutions would be rescued and which would be allowed to fail. One man, with one judgment, stabilized the entire American economy. Markets recovered. Panic ended. Life went on. But in Washington, the lesson was chilling. If the survival of the entire financial system depended on the judgment, health, and goodwill of a single banker, the system was not just fragile, it was politically unacceptable. Lawmakers were not afraid of panic. They were afraid of being powerless. From that moment onward, the question was no longer whether the system needed reform. It was how to redesign money itself. Publicly, the Panic of 1907 was framed as a failure of coordination. Privately, it was understood as proof that America needed an institution capable of acting during crises without asking permission, and without relying on private individuals. But Americans hated central banks. They associated them with corruption, elite dominance, and European financial empires. Any proposal resembling a central bank would have been politically explosive, so the solution had to be invisible. Planning moved into private rooms. Bankers, economists, and political insiders collaborated not to overthrow the system, but to rebrand it. Language became their most powerful tool. They did not call it a central bank. They called it the Federal Reserve. Something that sounded public, restrained, and harmless. They did not say money creation. They said elastic currency. They did not say control. They said stability. The design was subtle, brilliant, and nearly invisible. Create an institution capable of expanding credit in emergencies. Allow it to operate independently of elections. Shield it from public scrutiny, and above all make it boring. By the time the proposal reached Congress, Opposition was fragmented. The language was technical. The implications were abstract. Timing was perfect. December 23, 1913. Most lawmakers had already left Washington. Christmas was just days away. Attendance was low. Debate minimal. And in that quiet moment, the vote passed. No alarms sounded. No immediate consequences were felt. That was the genius of it. The dollar did not collapse. Prices did not explode. Life continued as normal. But beneath the surface, the rules had changed forever. Money was no longer constrained primarily by physical limits. It could now be created through lending. Debt became the engine of expansion. Inflation became structural, not accidental. Power shifted slowly and visibly. Decisions about money moved away from voters and toward institutions designed to act without public accountability. At first, benefits were undeniable. Crises could be softened. Panics delayed. Markets recovered faster. Stability became the new normal. But every new layer of stability carried hidden costs, costs that would only reveal themselves over decades. Every subsequent crisis followed the same pattern: expand credits, lower rates, suppress consequences, delay pain. And every delay required greater intervention next time: the Great Depression, World War I and II, the 1970s inflation crisis, the 2008 financial crash. Each event justified more expansion, more debt, more dependence. The dollar survived, but it transformed. No longer simply a store of value, it became a tool of policy. Inflation no longer arrived as a sudden disaster. It arrived quietly, steadily, invisibly. Purchasing power declined slowly enough to avoid revolt, but steadily enough to reshape behavior. Savings lost meaning. Assets became necessities. Those closest to credit benefited first. Those relying on wages fell behind. This was not incompetence. It was design. A debt-based monetary system must grow or collapse. Stability demands expansion. Expansion demands inflation. Escaping this system is nearly impossible. Governments rely on cheap borrowing. Markets price assets around intervention. Retirement systems assume perpetual growth. Citizens are trapped between rising costs and stagnant incomes. Every generation inherits the consequences of a decision it never voted on. That is the 112-year trap. Not a dramatic crash, not a sudden collapse, but a system so deeply embedded that questioning it feels radical. The Christmas vote did not destroy the US dollar. It ensured the dollar could never stop expanding without consequences. And once money becomes political, history stops being accidental. Consider today, inflation quietly eats savings, asset prices rise. Crises appear manageable, and central banks continue to intervene. The pattern remains the same. Every intervention delays consequences, creates more debt, and strengthens dependence on the system. Most Americans never question it. Most accept it as normal. And that is exactly what the architects intended. It is a slow, invisible trap built over decades. One vote, one institution, one principle: money must serve the system, not the people. And if you wonder why the dollar continues to dominate, why financial crises are predictable yet unavoidable, and why ordinary citizens struggle to keep up while elites profit, this is the answer. The system is designed this way. History is not accidental. Money is political. And those who understand the system have already positioned themselves to profit while everyone else adjusts, year after year, crisis after crisis. This is the 112-year trap. If you want to uncover more hidden histories, understand the structures controlling modern finance, and see how the past shapes your present, subscribe to Finance Historian Time. Because the past is not over, it is still charging interest. And it will continue to shape your life, your wealth, and your freedom whether you notice it or not.